Welcome to today's webinar, The Case for Tax Incentives for AEC. My name is Jaden Anderson with Civil and Structural Engineering Media. Thank you for joining this webinar, which is sponsored by Brain Consulting. Before I begin today's presentation, first some general information about the webinar and the GoToWebinar platform. The views of the speakers and organizations participating in this webinar are their own and do not necessarily reflect those of Civil and Structural Engineering Media or its publisher, Zweig Group. If you have any technical difficulties while viewing this webinar, please submit questions or a brief explanation of your technical problem using the question tab on the GoToWebinar control panel, and a representative will assist you. During the webinar, you can also submit questions to our speaker using the same question tab. Submit your questions at any time and we will try to answer as many as we can later in the webinar. Zweig Group encourages group learning for our events. If you are viewing the live webinar with the group on one person's registered computer, that person must complete and submit the multiple viewer registration form for the group in order for everyone to earn credit. Download the multiple viewer registration form from the handouts tab on the control panel. Submission instructions are on the form. Viewers of archive webcasts must pass a quiz in order to download the certificate of completion. Today's presenter is Brady Bryan. As Brain's founder and CEO, Brady brings optimal value to mid-market clients through specialty tax incentives in a number of industries, including architecture, engineering, construction, manufacturing, and software. A licensed attorney in California and Texas himself, Brady has assembled an all-star team of brainiacs. This powerhouse team is comprised of lawyers, engineers, and accountants hailing from Big Four and other national consulting firms. Brady's goal is to educate businesses and people on how to avail themselves to the little-known tax incentives that are designed for them. In this way, he knows Brain can make a meaningful impact with real people. Prior to founding Brain in 2010, Brady has spent many years in industry as well as Big Four accounting. During his tenure at Deloitte, he first learned about several of the tax incentives his company now specializes in. He also spent several years doing indigent defense work. Brady has a Juris Doctorate from Southwestern Law School and a BBA in management from the Sam Houston State University. He lives in Las Vegas with his wife, 3 children, and 3 French bulldogs. And now I'm going to hand it over to Brady.
All right, thank you so much, Jaden. I really appreciate it. Let me share my slide deck. And Jaden, can you see my slide deck there?
Yes, absolutely. I got your video and I got your slides up. You're good to go.
Perfect, perfect. So let me just start from the beginning. Today, we're going to be talking about the case for tax incentives for AEC, Architecture, Engineering, Construction. As Jaden mentioned, a little bit about myself. I'm Brady Bryan. I'm the CEO of Brain. We are a specialty tax incentive consulting company based, and then a little bit about me. Born and raised in Houston, Texas, went to Sam Houston State undergrad. I spent the first 10 years of my professional life working for an oil and gas engineering company called National Oil Varco. Love that so much. Ended up going to law school out in LA and stayed out ever since. Became a licensed attorney in California and Texas. And this month we are celebrating 10 years of Brain, our 10-year anniversary at Brain. And a little bit about us and our firm is we're about 20 folks. As Jaden mentioned, about a third of us are attorneys. Don't hold it against us. About a third of us are engineers, and the remainder accountants and interdisciplinary folks. We're based in 6 different states, 9 different cities, and serve clients and many more than that. We do R&D tax credits, cost segregation, 179D, 45L, fuel excise tax recovery, and of course, tax controversy support related to all of those incentives. Today's presentation, we're going to be diving into recent AEC federal and tax court cases involving 2 very lucrative incentives. One, which many of you may have heard of, the R&D tax credit. Number 2, the 179D energy efficient commercial building deduction incentive. And we're going to walk through specific cases that touch on architecture, engineering, and construction. and I would love to see your questions throughout. I will be emailing out this presentation to everybody, and also there are several handouts that we've included in A&E one sheet, our brochure, as well as the populous case article. We're going to be discussing the populous case, and I can't wait. Objectives today: understanding the basics of both incentives, determining who is eligible for these incentives, understanding the importance and key elements of allocation letters, understanding the definition of funding for R&D purposes, and understanding the basics of surviving an R&D and 179D exam. And that said, let's dig in. First, let's have our first polling question. Number one, what is your experience with these incentives? We're taking R&D and 179D. We're taking R&D only. C, we're taking 179D only, or D, we're not taking either. I'm going to go ahead and launch this poll. And just take a minute there. We'll give it about a minute. We'll wait till we get about 80% of folks answering there. Looks like everybody has already got a jump on this morning. Everybody's had their coffee, or afternoon, as it were, for many of y'all. You'll have to forgive my y'all. I kept that from Texas. So we'll wait just a few more seconds here. All right, everybody's on the ball. We're seeing a good mix so far, and I'm going to share these results with everyone. I did not include too many polling questions in today's presentation, as I really just wanted to get down to the nitty-gritty and hopefully field some questions from each of you. And it looks like we're still have them coming in about 60%. I'll give it a few more seconds. We're going to close it up here in about 5, 4, 3, 2, and 1. And then I'm going to share these results with everyone. And Jaden, can you see the poll results?
Yes. Yep, I can see it all.
Okay. For some reason, I am not seeing them on my end, but I do see the actual results here. So 5% we're taking R&D and 179D, 10% we're taking R&D only, 5% we're taking 179D only, and then 79%, not unsurprising, we are taking neither. And I would love to hear folks' thoughts on, well, there's a question from one person: how many folks on the call? We've got about 115 folks on the call, Tim. And then I would love to get some comments from the folks, and we'll keep it anonymous, on the folks that have not taken it, on why. If you've heard about it, if you've been scared off about it, haven't had time. But in either case, let's go from the remainder of the slideshow. So we're going to go right into a case called Quebe. Would love to hear from folks on whether or not you've heard of Quebe. I don't know why this is starting from the beginning. Jaden, can you see Quebe on your screen?
Yes, we're good now.
Quebe R&D, perfect. So case facts, a little bit about Quebe. Quebe is an electrical contractor, very large electrical contractor. And this overall is an unfortunate case for this taxpayer, but very fortunate for architects, engineers, and really specialty contractors at large. And I'll tell you why. This goes back to really 2013, where the taxpayer claimed an R&D tax credit and 179D deduction by amending their 2009 return. They ended up with about $150,000 in R&D tax credits and $270,000 in 179D deductions, and were refunded in August, so within about 4 months, except for the carryback. So they lost a little bit of money on the carryback, but were refunded the remainder. Again, 2013, they claimed the R&D tax credit and 179 deductions on amending the 2010 return, and that involved a similar amount of money, and they were refunded on April of 2014. Then cue the IRS examination in February of 2014. Now, this case is a little bit different because this is where the IRS has already refunded the money. The government brought an examination, and within about a year, just a little over a year of an examination, they determined that this was given an error. And so the United States Department of Justice brought a civil suit pursuant to Section 7405. And this is an erroneous refund recovery vehicle. And so also this is a summary judgment, and that's important to note too, because summary judgment is not necessarily a good thing. It's definitely a bad thing for the party that was summarily judged against. But here it went in favor of the government. And we're going to talk about, there was a lot of analysis in R&D and 179D both. It's, I think, has more guidance on the 179D issue, but there was some discussion of the R&D tax credit. And because of that, I want to give everybody a refresher. So number one, the R&D tax credit is just called that because that's the way people have named it throughout the years. I really don't like calling it like that. I really like to call it the research and design tax credit, because that's exactly what it is. It actually comes from Section 41 of the Internal Revenue Code. It's a credit for increasing research activities. And to qualify for the credit, you've got to pass these 4-part test, all 4 of these 4 parts. And so the first, the left-hand side, I'd like to distinguish from the right-hand side. The left-hand side, we have to be doing something in regards to a permitted purpose and technological in nature. So permitted purpose is we're doing something new or improved as it relates to a product, process, technique, formula, invention, computer software. And also this can include functionality, performance, quality, reliability, durability. And certainly whenever an architect or engineer or specialty sub and some contractors get projects, there is this new aspect where they typically have to go to the drawing board and do certain things that may qualify for the R&D tax credit. And so new projects could qualify too. Also technological in nature, and usually that's easy to meet because what does it say here? Ding, ding, ding. Principles of engineering. Architecture and engineering, smack dab in the middle of principles of engineering. Usually that's easy to meet. The thing in technological in nature is we're excluding the soft sciences and pure business management related decisions. So the left 2 boxes are easy to check. The right 2 are a little bit more difficult to check, but I've got a good example for you. So number 1, uncertainty. Here we're talking about technical, objective technical uncertainty. So what is the final or most appropriate design of this particular building, system, what have you? That is technical uncertainty. Process of experimentation. And this doesn't have to be the old scientific if then null hypothesis experimentation where we're testing controlled variables. This can very well be trial and error, systematic evaluation, and just iteration. An example that I think is a good example, if you've got any model or drawing that is beyond a revision 1, so Rev 2 and up, that is proof in the pudding. Number 1, we're talking about an engineering or architectural drawing, so we're talking about principles of engineering. We're talking about something that's definitely new. And there was some kind of objective technical uncertainty, otherwise it would all be revision 1. So I hope that helps everybody in the 4-part test refresher. So, in wrapping this up, if we meet all 4 components of this 4-part test, then we're doing R&D. Now, to Well, we're getting actually a lot of questions in here, so we'll take a break after this case and field some of these questions. Please feel free to send more in. This was a summary judgment in the government's favor. Here, the summary is that Quebe used an invalid R&D calculation. Quebe did not substantiate the R&D claim, and there was some court discussion about Quebe qualifying in the research. And really here, it's a shifting burden. And the title of this course is The Case for Tax Incentives for AEC. Now, in this particular frivolous refund claim that the government chose as a vehicle to obtain that because it was their only vehicle, the government bears the initial ultimate burden of proving that the tax refund was erroneous and to what extent. The taxpayer, however, in this case, has the burden of showing its right to any claim benefit. Now, on the flip side, the taxpayer, in taking any R&D tax credit in 179D deduction, needs to be prepared to substantiate that. What does that mean? Is at the end of the day, the onus is on the taxpayer to make the case that they're deserving of that credit. And digging in more into this, while there was some discussion of R&D in general, this is what the R&D case was held upon. So the Quebe company extended, it went prior to what's called the base period. So it existed and performed research and development in years prior to 1984, which means it's a traditional base period company. And that means we have to look at the, and Congress in their infinite wisdom decided that 1984 to 1988 is a good period to mark in history, so that we need to look at qualified research expenses and gross receipts in those years and forensically reconstruct that period. So number one, there's a couple of ways to do it. That is one way. Another way is the startup period, that you can see there to your right. And really here we look at the first year with gross receipts and qualifying research expenses. Oh wait, I didn't mean to click. After 1984 to 88. So if there were fewer than 3 years in 94 to 88 with that, so let's say you started in 1987, or let's say you started in 1990, then we would use the startup period, which is it looks at a different, really moving average of years. And so long story short, there's two different calculation methods to use, the traditional base period method versus the startup method. Here, there was a couple of things that the IRS pulled out in their questioning and depositions, is that Dennis Quebe, the owner, testified that R&D activities, in fact, did occur in 84 to 88. So that is significant here, is so the IRS depended on this saying, yes, number one, an electrical contractor is doing R&D, and that they were doing them in years 1984 to 88. So I think that is a somewhat significant thing to pull from this. But also, the taxpayer only provided evidence at trial or here that, number one, the consultant testifying on their behalf, and it was ruled inadmissible hearsay, and that the consultant said that R&D did not occur from 84 to 88, which contradicted Dennis Quebe's testimony. So assuming that in a summary judgment, they said that no, this is definitely a startup or a base period company. You had to have used the base period in that calculation. And so we're already past the statute of limitations now, and it's too late to go back. So too bad, so sad on that. So moral of the story there, they got them on a procedural issue, which was using the wrong methodology to calculate that credit. So here, I think there are some really important notes to pull out of the R&D section there, and I want to make sure it looks like we have good timing on this. The IRS examination didn't include any review of the documents of the interviews. The IRS internally produced from the get-go a pro forma disallowance template at the beginning of the exam. What does that mean? That, you know, they went into this with really a jaded view. And that's not uncommon. We've seen similar treatment, not only of, it's not really targeting construction or AEC in general. We've seen similar treatment for other firms across the board, whether it be robotics or software or what have you. Sometimes you do see that, and sometimes that information does come out. And just historically, I've been doing this for almost 15 years now, and you sometimes see that treatment. And another thing that's here is that the IRS did oversimplify construction activities, and really the whole design process, design bid build, as well as design build. It does seem like there's an oversimplification of that, and maybe lack of understanding. And so really, again, the case for tax incentives for AEC, the burden is on us. The burden is on us as an architecture and engineering and construction company and the consultant to make that case. So have good people, hire good people that can make that case for you. So before we go into QUEBE 179D, does anybody have any questions on the R&D side of things there? We're actually making really good time. And Jaden, is everything technically still going good on your end? You can hear me and see everything fine?
Yes, everything is perfect.
Okay, perfect. And seeing if there's any other questions. Why did the government sue in civil court? I thought that the IRS could simply rule. Well, that's a good case, and the IRS can rule, but here they already issued refunds. And so the government was trying to get their money back. So, you know, the IRS did rule, they did disallow it, but how does the government go about getting their money back with interest? So there is that. Really good question, though. So we'll give it just a second to see if anybody has any R&D specific questions, and you don't have to speak now or forever hold your peace. Always available if you have any questions later or even later on this call. Okay. We are going to move on to 179D. I know everybody is excited about this. This is so interesting because this is one of the things that few people ever thought would be examined or examined to any level of detail. But the IRS is a smart organization. And while they may not, you know, understand all the nuances of architecture, engineering, construction, and design, the entire design process, they're a smart organization. They are a law enforcement organization and one of the largest law enforcement organizations in not only the country, but the world. So in that, before we dig into it, let's cover the 179D basics. Let me put on my professorial tweed jacket for a moment. This is not tweed, but it'll do. Really, here, this involves government-owned buildings that were constructed from 2006 to 2020. Does anybody have any idea why this is now extended through 2020? Well, I gave it away. It was extended this year to include buildings. It previously was only extended through 2017. Now it's extended for 2018, 2019, and buildings currently being constructed through the end of this year. Who can be a designer for purposes of this allocation? This designer can include architects, engineers, and contractors. Depending on the jurisdiction, sometimes contractors are not eligible pursuant to allocation letters, but from a technical perspective and through the IRS notice and cases, a contractor can certainly be eligible. But in general, it's AEC. And here, more specifically, while this was intended to help private business owners accelerate depreciation, what do we do in the case of government building owners? Well, they can't depreciate, they're not a taxpayer, so they can allocate that depreciation to whom? Again, architects, engineers, contractors, anybody that's a designer. of technical specifications for the installation of any of these systems, HVAC, hot water systems, so the mechanical systems, interior lighting systems, or building envelope systems, or all of the above or some of the above. And so there is eligibility for any or all or some combination. Also, it involves new construction, renovation, and building additions. Typical example government owners include school districts, universities, local city, county, libraries, you name it, Social Security offices, state facilities and military facilities, and the like. What does this mean for the taxpayer in this case? If you receive that allocation, anywhere between 30 cents to $1.80 per square foot. What we can't have, and as we'll see in some of these cases, you can't have more than $1.80 per square foot of that same building allocated, but you can have multiple parties. And so if there's any question on that, looks like we do have some questions coming in, which we'll take a look at here in a second. But this is love this case. Good grief, let me, I don't know why it, for a number of reasons. So there's two groups of buildings here, the Air Force buildings and these schools. Now, the Air Force buildings, Quebe was claiming a 170 deduction, not only on the 2000 on these projects, but here was the deal. They were claiming them in 2009, so this was a timing issue. But the projects were actually completed, and these were public projects. It was easily verifiable, not completed until 2011. And so the timing is of the essence there. We had a couple suspicions of why it may have been included in 2009. But now on all these cases, I just want to make a disclaimer. These are not, we didn't represent these clients. These are not our clients. And we don't have any inside knowledge that we're sharing here or know of. So just as a caveat here. And so on the Air Force Base buildings, there was two things. So number one, Quebe claimed the deduction in 2009, and some weren't, and it wasn't completed until 2011. And also, it's interesting to note, you know, a lot of folks, they said, hey, all we need to get is an allocation letter. You know, it really doesn't matter about the details. And this case shows that it does. And one of the things that I think was very smart about the IRS here, the IRS didn't look at this in a vacuum. They looked all around. They asked the other architects of record involved, the engineers of record involved. They talked to folks. They talked to the government entities. They found out the entire story. And here it did look like more than $1.80 was allocated out on the school side of things. And so going back to the Air Force Base, the bottom line is that Quebe could have been a designer for purposes of this and otherwise was eligible for that deduction, but for the timing. So they didn't take it in the right year. And by the time this was uncovered, it was too late, too bad, so sad. The statute of limitations has passed and they could not correct that. Also, another thing, site inspection. Site inspection is key. Site inspection is critical. It's important to get people that have been around a construction site and know what to look for. Here it looks like there was 170 deductions taken on buildings it didn't even work on. So really timing, scope, really making sure that we know what we're taking. There was site inspection on a building that wasn't even one that they worked on. Also, was Quebe a designer on certain cases? Well, the court ruled that, you know, Quebe was not a designer for when they were only installing lighting fixtures or picking lighting fixtures out of a catalog. So if you're actually involved in the creation of the technical specifications for the installation of any of those systems, then you're a designer. If you've got a hand in that, then you're a designer. If you're only picking information out of a catalog, you're not a designer. And that's what happened on at least one of the school cases. And another thing is that allocation letters are important. It's important that your consultant know what to do and does the smart thing, because here the taxpayers can obtain an allocation letter from custodial staff after the school already allocated to the architecture and engineering firms. So these are all things to really pine upon and to consider. Additional notes is that the IRS confirmed that, again, this is a good takeaway, that Quebe was a designer on multiple projects. Again, the Air Force Base, it was a timing issue. The IRS, in some cases, does lack the ability to provide substantive exam. However, we have seen an increase in exams on compliance issues. We've even heard where they do have folks that are looking into the actual energy modeling. And so, as you know, there's several components to a 170 study. There's the allocation letter, which has many technical components and elements that need to be met. There is the site inspection, which also has some technical components that has been a little bit oversimplified over the years. There's the energy modeling, and then there is the certification. Certification must be done by a licensed engineer in that jurisdiction. Can also be some other folks, but primarily needs to be a licensed engineer in that jurisdiction. So you got to make sure that you're taking and crossing all your T's and dotting all your I's, because this case looked at every I and every T to make sure it was crossed and was found wanting on several occasions. Additionally, about the same time this came out, and we're still doing good on time, doing great on time, the IRS Office of Chief Counsel issued this memorandum in November, just before the Quebe holding was released. There might have been some reliance upon this Chief Counsel memorandum here. Now, if you get the opportunity, it's quite voluminous. There's a lot of information in there, and there's a lot of scenarios about eligibility of designers, builders, and claiming the deduction. What is interesting is that there is a school of thought in the past that you had to claim that in order to claim the entire $1.80 per square foot, that you had to be a designer of all three systems, and that is not the case. Brain has never held that position, but you do have to meet that ASHRAE threshold, and it's a moving ASHRAE threshold. Currently, it's a 2007 ASHRAE threshold, and in order to get that full $1.80 per square foot, you need to be more than 50% more efficient than that 2007 standard in for 2017, 18, and 19 and 20 projects placed in service. So really, in recapping all of this, it's pretty evident that there's an oversimplification of the AEC vertical design process, design and construction process. And here it's interesting, the IRS, now the Chief Counsel memo has guidance, I guess, strategic reliance, but we can't rely on it for precedent. This cannot be used as precedent. And this is really mere IRS advice to the LB&I, large business, high net worth individual group of IRS. And so those are the primary things to take away from this particular case. And before I go forward, anybody have any specific questions? There are actually some really good questions, but specific on Quebe. I'll take a minute to see if anybody has any questions, and then we'll see. You know what, at this time, let's do our second polling question. We're just over halfway through, and I'm going to go ahead and launch this. And this is really evaluating your experience with examinations from the tax authorities. Have you been examined in the past? Number one, A, our exam is ongoing. B, our exam is complete and we sustain all or most of our credits deductions. C, our exam is complete and we had a negative experience there. Or D, not applicable. We'll give this a few seconds. I want to get a little bit of guidance from everybody's experience here. So far, we've got just 40% voting. Give it about 10 more seconds. That's great. We're seeing some really positive experiences in exam as well. We're not seeing anybody sharing that they had a negative result, which is also not uncommon. Even if you did, it's not typically something we champion. And those results can be negative for a number of reasons. Least of which is not the least of which is that the IRS is a very powerful organization that can sometimes bully taxpayers. Okay, so we're going to go ahead and close this out. We've got about 60% of the people. We'll close it out in 5, 4, 3, 2, and 1. Then we're going to share this. By the way, if you want to minimize my ugly mug on the screen, there is a little white dividing line in between the presentation and me. You can put your mouse over that line and drag it up to minimize me so that you have the slides front and center. And so we've got about 4% of the folks that answered said that their exam is ongoing. About 4% said our exam is complete, and we had very positive results. About 1% said that our exam is complete and had negative results, which can mean a number of things. And then 90% said not applicable. And I would love to hear from the folks also that had a negative experience result about some things that were impactful there. And can a private utility qualify or have to be city or county owned? It has to be government owned to be a 179D eligible project where you get that $1.80 per square foot deduction as an AEC individual. So government owned, city, state, agency, as long as it's government agency, federal, county, secret agency. There's a few of you that deal with secret agencies. There's a question, is the IRS notice, if the IRS notice says that the primary designer, so how is a contractor eligible? And it all works out to whoever has a hand in the creation of the specifications in regards to the installation of those systems. And so certainly on a design build, a contractor or specialty sub could be that person. Okay, and so we are past the memo here. We just did our second poly question. Now on to Populous. This is perfect timing, right on schedule. Who all has heard of Populous? Populous Sports. They make fantastic venues all over the world, from football stadiums to music venues and all in between. Used to be part of HOK Populous, and then around 2010-ish was spun off or purchased themselves out, or I'm not sure of the specifics, but became a separate company around that time. And so a little bit on the background, this is called Populous Holdings Inc. versus the IRS. It was a U.S. tax court case. Populous Holdings is an architecture firm, and they claimed R&D tax credits in 2011 and carry forwards from 2010. Now there was many projects, hundreds of projects that they took. The IRS narrowed it down to 5 projects for review. All of these were fixed fee, and 3 had actual reimbursable expenses even. The final holding, I love to start with the conclusion. If law school has done one thing for me, it's done that, is Unfortunately, when I'm reading a novel or a fiction, I go to the last chapter first and then I read the rest. Let's start with the conclusion. Research here was not funded in the contracts. Payment was not contingent on the success of the research, and that the contractor retained substantial rights on the research, enough so that these could otherwise qualify for the R&D tax credit, or as I like to call it, the research and design tax credit. This is a huge win for taxpayers for a number of reasons. Number one, this is really one of the first cases we've had specifically on point directly with with an architecture firm. That is the biggest thing. And number two, it really solidifies our thoughts on funding that goes back many, many years, back to, I think, 95 with the Fairchild and Lockheed Martin cases. And so we actually see a lot of clarification there. And also we see clarification on the Geosyntec case, which is another engineering case straight on point that we're going to dig into a little as well. Previously in the past, we had to really borrow more of analogy, and in some cases still do, from all of those cases combined, even including the Trinity case, which is a ship design, shipbuilding company that had some tremendous, I think, results in holding Fifth Circuit Court of Appeals case that has a lot of analogy and implications for architecture and engineering as well. But let's dig into Populous. Really, so in this court case, the court held that the fixed fee contracts, fixed fee in general, is inherently risky. And that was really language that was borrowed from the Geosyntec case, which we'll dig into. But really here, the most helpful language is that a conditional obligation to pay is not required. I skipped forward there. For research to be considered unfunded. It's a little bit confusing here. So going back to the four-part test on research and development tax credits, we meet that four-part test. But even if we do, if that research is considered funded, then we don't get the credit. So being funded is not an area we like to be in. That doesn't mean time that's billable. It doesn't mean that we can only take internal research and development time, or time that's otherwise in overhead doing internal development, research on, materials and mass timber and things like that. That's not what it means. It can certainly be things that we're paid for, as long as the payment for that research is contingent on the success of that research. In other words, a fixed fee contract is a good example of that, where we don't get paid unless we deliver results. Really helpful language here again is that a conditional obligation to pay is not required. None of these contracts expressly requires research, and so that's important. So an architect engineer says, Brady, how can this not be funded when we're being paid to do this? And they're saying, hey, just design this, right? They're not telling us to go perform research or do this, this layout research or integration research or research on materials. That's just inherent and incidental to our job. That's right. And the court here says that's fine. So it doesn't specifically require an architect or an engineer to go out and be language in the contract to go perform research, to get a contract going with XYZ University and start studying this. That's not what that means. So this can be normal, projects where we're having to perform qualified research and design and development in order to comply with the terms of that contract. And
hey, Brady,
yes.
Your slides, I think, may have frozen. Right now, what we see is just your speaker slide.
Oh. Let's see. What do you see now?
Same thing.
Let's see. My apologies, not sure what happened there, but we'll start from the beginning. And we are caught up. Can you
It's
see?
it's a little zoomed in, so you can't see the whole slide for some reason.
Huh. What about now?
I can see it now,
But now you
and it
see
has the other slides on the sides. Yeah. But it might be better just to be able to see the whole slide.
Yeah, that'll be fine. We'll just keep it like this. And I'll send
Perfect. Thank
everybody.
you.
Oh, thank you so much for that feedback, Jaden.
Okay.
And let's see if there's any other questions as we're going through this. There was a question on Quibi. Was Quibi in danger of any criminal suits? Not likely, or I don't know of anything there. It normally has to be pretty serious to get a referral to that different group of folks. Let's see if there's any. Are the PDF handouts not? The PDF handouts are not downloading. Jaden, so there was a comment that the PDF handouts are not downloading. I don't know if that's.
Yes, I answered that person. I will make sure that I emailed them after this webinar, and I will include it on our follow-up email after this webinar as well, just to make sure.
Perfect. And then I'm going to finish going through this before I answer anymore. We're actually making good headway here. So really at the end of the day on Populous, in addition to having just a enormous landmark case here that really solidifies a lot of our prior cases, additional facts, the court found that Populous retained substantial rights to the use of the research. So we not only looked at risk, so economic risk of loss in those contracts, but we also looked at rights. Do we have rights? And in here, even when the client owned all the documents, that we don't own the documents, as long as we can, really use the research related to that, then we're fine. That was enough here. So here that they received no rights, their clients received rights to all the documents, copyrights. They didn't have any of the copyright, but they had that underlying residual knowledge that they developed that they could use going forward. And as long as they could use that research that they performed and learned without the client consent, or without paying for that, that's enough. That's enough. The court noted that ownership of the documents does not dictate the right to use technology related research. And there's no provision in the contract that prohibits the petitioner from using related research technology in its business. And typically we don't see any rights. Rights usually is not the issue. Typically we see rights as being obviously contractually driven, but where we see it, being problematic is on secret government research type of things, DARPA related technology and development, and even Disney contracts are pretty tight that prohibits rights there. So in some cases, so rights was an interesting thing here, and I'm glad they brought that up. So another thing is, even though the case does not create, and this is important here, because while the case delivered to us more on the fixed fee contracts, what about architecture and engineering qualifying at a 4-part test level analysis, Brady? And so even though this case doesn't really go into that at the summary judgment level here, I think it goes without saying, had there been arguments there, valid arguments, that it would have been brought up here at the summary judgment level. And the fact that the IRS hinged its argument on funding, which was, to me, is a weaker argument here when you're dealing with fixed fee cases, hinged it on funding rather than arguing that the taxpayer did not perform qualified research, provides some support for the inclusion of architectural design as R&D. And so to me, it's not just what's said, but a lot of times what is not said is loud as well. So that speaks volumes there. Another thing is that Populous did speak about 3 different additional cases here. the Geosyntec case, the Fairchild case, the Lockheed Martin case, which we're briefly going to touch on. And we dug into this a little bit more. If you're so inclined, we have this article we've included in the handouts, but I've also included a link to the article if you'd like to check that out later. So we've written an article on the Populous case and the analysis that's included in the handouts there. But really, Geosyntec here, it did go into that and clarify that Geosyntec was a case that looked at not so much fixed fee contracts, but cost plus fixed fee with a cap. And so it's important to note in Geosyntec that the IRS there had no problem with the fixed fee contracts, and that those were held to be at risk there, at an economic risk of loss, where Geosyntec had to deliver successful research in order to get paid. Where the IRS had problems here was on the cost plus fixed fee contracts with caps. And there's a deeper analysis that we'll briefly touch on there. And so there's two different really analysis. At the end of the day, there's one analysis. Number one is payment contingent on successful delivery of, or successful research being delivered. That's the big analysis. But when we're dealing with cost plus fixed fee, it can go a little deeper. As well as potentially time and material and not to exceeds. It's a deeper analysis, and it behooves the taxpayer, you, us, to go to take those extra steps and go through that analysis. So that's Geosyntec. Fairchild Industry is another one that deals with risk that goes all the way back to 1995. And that is where the taxpayer was designing jets and building jets. And really there, even though they were being paid, the court held because, and a big thing there was inspections, that in order to get paid, they had to complete milestones. There was third-party inspection. Actually, I don't think it was necessarily third-party, it was part of the government inspecting each portion, making sure that everything was successful and delivered prior to payment. And that's a little bit different than A&E because we don't always have that mandatory inspection. A lot of times the inspection clauses allow for that third party, but it's not necessarily expected or doesn't necessarily happen. Usually a lot of times will happen on the construction side, where you have to warrant your design and go back and fix any designs at that time. And again, the Lockheed Martin case, again, all engineering related cases here. Goes back to 2000, and that had to do with a rights case. As long as a taxpayer retains substantial rights to the research, then that's enough. And here the court really solidified that and clarified it a little bit more. It's important to note, I think, and Jaden, can you see the analysis summary here, the white slide?
Yes.
Okay, perfect. Really, this is on the analysis summary. If you wanted to dig a little deeper, these are the kinds of things, if your consultant is asking you for contracts, this is hopefully what they're reviewing and why they're asking you. At the end of the day, we're looking at who bears the risk if the research is unsuccessful. Are you still going to get paid? Or are you not going to get paid unless you successfully deliver? At the end of the day, that's the question. I could have delivered that like Shakespeare. And then how do we determine that? We have to really look at all the terms of the contract. Number one, of course, there's the statement of work. There's the scope of the contract. There's the inspection clause, which was huge in Geosyntec, huge in the Fairchild case, and huge elsewhere in the Populous case as well. Invoice dispute provisions and just general dispute provisions in general. Who's going to be the judge and jury in the event of a dispute, contractual dispute. Revision obligation, and that kind of goes with the warranty. Revision obligations covering related cost, payment procedures. That's huge. So Geosyntec, one of the big things there is like they were going to get paid for soil bench testing or whatnot, for example. If you send in your results, here's just an example. You send in your results to a port authority or some governmental authority of your spectrometer analyses, and here they are. There's really, how are you going to fail that test? You're just doing research on the soil, erosion control research, things like that, and the answer is whatever is in that scientific report. And typically, a civil engineer or they're going to get paid regardless. And so it really is more of an accounting exercise to make sure that the invoice matches with the purchase order, which matches with the statement of work and the overall master service agreement. And that's really all it is in a lot of cases. And if that's the case, it's likely not at risk. So the quality and performance standards was part of the analysis, and also part of the analysis in Geosyntec. Termination clauses, and again, warranty and default provisions. And it's not any one thing. It could be a combination or even a weighted combination of all of these. And so it is an area where it's a very fact-specific situation, and it behooves the taxpayer again to have competent people to research this, and to hire competent people that understand all of these things. Again, the taxpayer has to make the case for it. Key takeaways, and we are right on time, guys. R&D, AEC is target rich for R&D tax credits. 2, documentation is key. So we need to be able to document. We need to be looking at the right methodologies to calculate the credits, and how do we document that? Time tracking is a phenomenal way. Contracts, the devil is in the details. We just talked about a lot of the things there in various analyses, from fixed fee contracts all the way to cost plus fixed fee with cap. A lot of different contracts that can exist in between, and really the devil is in the details. So 179D, allocation letters, that's important. Understanding who a designer is, and that can vary. So understanding a designer for purposes of the deduction is important. And here we understand that depending on the project, then an architect can be a designer of a system, an engineer can be a designer of a system, and in some cases, a contractor and specialty sub can be a designer of a system. So that really brings us to the end. We do have a couple of questions here. Jaden, which ones do you think that we ought to address first?
Yes, I think we have some really good ones, and we've done a really great job of weeding through some during this. So we'll try and get through all of these. If your question isn't answered, I will make sure that Brady gets your contact information so that he can answer your question.
Perfect.
Okay. What is the relative cost of legal defense versus the refund itself?
Well, that's a good question. So I would first delineate what is legal defense. It depends on if you're a lot of consultants include exam support. And now exam support is different than taking it to court. Taking it to court's expensive. And I don't want to, that's something that Brain doesn't do. And so I don't want to step in the shoes of, law firms out there that do that, but it is expensive. Tax court is expensive as well. So those are all, things to consider. But certainly most of what we see is settled out at exam or administrative appeals. Administrative appeals, if you don't like what you're seeing at exam, if you don't feel that the examiner is hearing you, it is talking over you, it's not looking at the details, you're making the case, again, making the case for architecture and engineering, but they're not hearing you, then you have a taxpayer has a right to go to administrative appeals. And that's where you can usually state your case and go from there. In most cases are settled at exam. The remainder, a lot of the remainder are typically settled at administrative appeals or even remanded back to exam. But in the few cases where you can't get your way at either and there's a lot at stake, you definitely want to talk to a good law firm, which I'm not going to be recommending law firms here or CPA firms, but you need to know your rights as far as a taxpayer at tax court, as well as, federal court if it takes that. Or, in the case of Quibi, if you're sued in federal court for, to get the refunds back. So these are all, that's a really good question, and I'm sorry I don't have a more specific answer for you there.
Okay, next question. Can you elaborate on the definition of meeting certainty requirement one more time? Lump sum versus cost plus fixed fee contracts.
Okay, yes. So the first one, I'm going to give two analogies or two examples. Let's address the contract portion first. And so a fixed fee contract, lump sum contract, is typically where a taxpayer will receive a set dollar amount as long as they can deliver. And that may be broken up into milestones. It may be broken up in a number of ways, but at the end of the day, one or more payments will be contingent upon the success of that research, will be contingent upon them successfully delivering on what they said they were going to do. And so I usually lump in, pun intended, lump sum and fixed fee together, as they're very similar in nature and character, even though they're not identical. I would say they're both very similar for this purpose. Now, sorry, what was the first part of the question?
The first part was, can you elaborate on the definition of meeting certainty requirement?
Sure. And so going back to the 4-part test, that is a really good question. The 4-part test on technical uncertainty, we need to be dealing with an objective technical uncertainty. So can Apple make the next iPhone? Of course they can. But are they technically uncertain on the best way to do that? Of course they are. Otherwise, they wouldn't be employing a lot of software developers, designers, and imaginers, and everything else that they employ to come up with the best bundle of goods and the perfect size, shape, and everything else. So we're dealing with technical uncertainty, not unobjective, not subjective uncertainty. For example, subjective uncertainty, we've been living as human beings indoors for 8,000 years. Humans certainly know how to make buildings. Therefore, we certainly can design a building. That's subjective certainty. That's not what we're talking about here, and I hope that answers that question. So we're dealing with something that's technically uncertain. What is the final or most appropriate design of the HVAC system for this new building? That's the question. And if you're asking that question, then you're meeting the uncertainty requirement.
Perfect. Okay, we'll take just a couple more. We have this one that asks, once it has been determined which base period to use, how is the amount of credit calculated?
So the mechanics of the calculation, if we're talking about a traditional regular credit computation versus the alternative simplified credit. So the alternative simplified credit, let me start with that one first, because there's actually kind of 3 computations. The alternative simplified credit is much more newer. It's much newer and came about in 2006. And the Department of Treasury allows us to use it on a lot more things. Over the last couple of years, they've allowed us to use it on amended returns where we haven't made an election in the past, contrary to AEC. Alternative simplified credit allows us to look at 4 tax years, and we only have to look at the qualified research expenses related to those tax years. So if we're calculating a 2019 credit, we look at everybody performing the total qualified research expenses for 2019, and we compare them to 50% of the average of the qualified research expenses of the prior 3 years. And so there's that hurdle there, a base amount, if you will, that we have to clear. And the amount above that, we're able to take 14% of that for a credit. Now, going to the regular credit, we have to calculate a base amount. And that base amount is either going to be 50% of the qualified research expenses or the actual base amount as computed. And we take the delta of that, whatever's left over on top of that, how much we clear the hurdle, and we multiply that times 20%. I usually like to calculate it both ways and weigh the pros and cons of each. How do we get to that base amount? If we're a traditional company, we are looking at 1984 to 1988 qualified research expenses over gross receipts, and that's going to get us our fixed base percentage. That fixed base percentage we multiply times the prior 4 years gross receipts. And so if you have high gross receipts, now there is a 16% max on the fixed base percentage. So we do have that going for us. So for example, like a state like California, their definition of gross receipts is different. And so no matter what, we're looking at a 16% max times usually 0 or something less than their normal gross receipts, because the definition of gross receipts there. So usually it's a 50% limitation there versus the base amount limitation. I know I've thoroughly confused a lot of people there with the minutia on that, but yeah, so that's how the base amount is computed. The fixed base percentage times prior 4 years gross receipts. How you get to the fixed base percentage? A couple of ways. And then the alternative simplified credit, we can't discount that because that's a favorite. It's a newcomer on the scene that we certainly like to look at every time.
Perfect. Okay, we're going to take one more question and we'll get wrapped up here. Our last question today is, are time and material contracts with a not to exceed fee considered at risk?
You know, it depends. Everything is a case-by-case basis. And as you know, as we talked about the Populous case and the Geosyntec case, it depends. And at the end of the day, we're going to look at the 4 corners of that contract. It's called the 4 corners rule. And we're going to examine it. We're going to look at every single applicable contract provision. And we're going to see if this, you know, that's how you look at it. You have to perform an analysis, and it's really case by case. And so it's hard to say one way or another because we're talking about time and material with a not to exceed. It's in that gray area, and so you can't really broad brush and say one way or the other. We really have to look at the nitty gritty. I have seen not to exceeds that can qualify, and I have seen not to exceeds that can't. So it really depends on a project by project, contract by contract review.
Perfect. Well, thank you so much, Brady, for doing all of this with us. I'm going to take the screen back over here.
Perfect.
Okay, and we just have a couple of things to go through and then we will be done. So as we finish, please make sure to download your certificate of completion from the handouts tab in the control panel. I know there's a couple of other handouts in there. If you're having trouble with them, I am going to send out a follow-up email after this live event so that you will have all of those in your email as well. If you missed our note at the beginning and you are watching the live webinar with a group on one person's computer, please download the multiple viewer registration form, and that's also under the handouts tab. We need this information in case you were audited and we are contacted to verify this continuing education activity. There will be screenshots of your control panel to help you navigate these handouts at the end of this slideshow. Additionally, this webinar has been recorded and will be hosted on csengineermag.com/continuing education later today. And again, Brady, thank you so much for joining us, and we are going to wrap up here. Thank you so much.
Yeah, thank you so much. I appreciate it, Jaden. Thank you everyone for your time and your questions. If I didn't get to your question, I will follow up with you.